In this demonstration video for Comprehensive Problem 2-2b, our taxpayers are a married couple, Carl Conk and Mary Duval. They're going to file a joint return. Carl is retired, but he does work part-time, so he has a W-2. He was born in 1960, and Mary was born in 1970, which is important because if we do the math for Carl, if we take 1960 from 2025, we'll see he's 65 years old. So he's going to be eligible for an additional standard deduction. Mary is 10 years younger. She's just 55, so only Carl will get the additional standard deduction. Carl and Mary helped support an old Army friend of Carl's named Buster Crabb. Buster's 72, lives near Carl and Mary, and has a small Social Security benefit of $6,000. And so Carl and Mary provided for more than half of his support. And you'd think, since the couple provided more than half of Buster's support, that they could claim him as a dependent. However, if you remember back in Chapter 1, for a taxpayer to be claimed as a dependent, they have to be either a qualified child or a qualifying relative. And Buster is neither of those. He's just a friend and not related. So we can just really put this information aside because Buster cannot be claimed as a dependent. And it tells us that Mary's divorced and she pays her ex-husband, Tom, child support pursuant to their January 12th, 2022 divorce. The divorce agreement says that Mary has to pay Tom $500 a month in child support, and all of the payments to Tom were made on time in 2025. Now, there are some things we need to remember when it comes to divorce. There are 3 types of payment arrangements. The first one that we'll talk about is alimony. There are only tax implications for couples who execute a divorce agreement on or before December 31st, 2018. This is a very important date when it comes to alimony. For divorces before December 31st, 2018, the person paying the alimony is able to deduct the amount from their income, and the person receiving it has to add the alimony into their income. If the divorce is after December 31st, 2018, the alimony doesn't need to even be included on the return at all. So remember that date, December 31st, 2018. It's very important. And pay close attention because you're going to see alimony included on future exams. The second payment arrangement that we'll talk about involves property transfers. Property transfers are when the couple just divides up their assets. For example, one spouse may get the house and the other spouse may get the car, and they may split the bank account. With property transfers, there's really no tax consequences because they're just dividing up assets. There's no income involved. Now, child support is what Mary is paying. She pays Tom $500 a month, and all payments were made on time. Now, child support really has no tax consequences either. Mary's just helping to take care of her child, so you would not report the child support payments at all on either party's tax return. So we can just ignore that section. The problem says that in early 2025, Mary lost her job and was able to renegotiate her auto loan and had the balance reduced by $3,850. And this was reported on Mary's 1099-C for debt forgiveness. That reduction is an economic benefit to Mary, and the IRS is going to treat that as income. So we're going to have to take that into income for Mary. And then in June of 2025, Mary's father passed away and left $75,000 to her. That is an inheritance, and inheritances are not taxed for income tax purposes. They may be taxed if they're large enough, but that is an estate tax, not an income tax. So we don't have to worry about the inheritance either. Mary received an employment compensation, and that's reported on the 1099-G after she lost her job. And unemployment is taxable because it's considered a substitute for income, so we are going to be including that on her tax return. And then lastly, Key Lime Company provides Carl with a gym membership on the premises of the pie factory that he works for. A similar membership would be worth $1,200. But since the gym is located on the premises that the owner owns or leases, the employees do not have to include the value of the membership in their gross income. It's just considered a fringe benefit, so it's not taxable and does not need to be reported. So now let's move over to Carl and Mary's return. We are going to be completing Form 1040-SR for Mary and Carl. It is specifically designed for seniors or those who are age 65 and older. It's more simplified than the 1040, and it's got larger print and easy to read standard deduction tables. There's really not a whole lot of difference between the 1040 and the 1040-SR. It's an optional form. The taxpayer can choose to use it or not. A 1040 would be fine, but we're going to take a look at it because we do have a taxpayer that's over 65. On your tax return exam, you're just going to be filling out the normal 1040. We're also adding the Schedule 1A because it is going to help us with additional deductions for those who are over 65. Now we've listed at the top of the 1040-SR the name of our taxpayers. We've got Carl listed first with his Social Security number, and then Mary. We have their address, and we've checked the box to indicate that both of them lived in the United States for more than half the year. Neither want to contribute to the presidential election campaign. We're going to click Married Filing Jointly for them, and going to indicate that they did not have any digital assets. We determined earlier that they do not have any dependents. They could not claim Tom, even though they provided more than half of his support. So now we'll just go and look at Carl's W-2 from the problem. Okay, the W-2 is showing that Carl earned $25,200. So in box 1A, we're going to enter $25,200. That is all the earned income that they have. So I'm just going to bring that 25.2 down to line 1Z. We know that Carl also has some retirement income, pensions and annuities, so we're going to look there, and we'll see that his gross distribution was $14,100, and it's telling us the amount that's taxable is $14,100. So over on his tax return, we're going to enter that amount on here. Pensions and annuities. We'll put the total in box 5A, and then the taxable amount in 5B. He also had Social Security benefits. If we scroll down, we'll see his Social Security statement. The benefits paid were $7,810. So we'll move that over to the Social Security line. Now we're not sure right now how much of that is taxable. So once we get Mary's income included, we're going to come back and figure out how much of the Social Security is actually taxable. So now let's go back to the problem and take a look at the other income that Mary and Carl have. They have the amount of debt discharged reported on the 1099-C for cancellation of debt, and that was $38.50. And then Mary had unemployment income. So she has $2,400 in unemployment compensation. Both these figures are going to go over to the form Schedule 1. Remember on the additional forms to always make sure that you have the taxpayer's name and Social Security number at the top to avoid losing points. The cancellation of debt was the $38.50, and that is going to be reported right here on line 8C. So we'll enter the $38.50 there. She also had the unemployment compensation. That's going to be reported on line 7, and the form 1099-G said that was $2,400. So now that's all the additional income they have. So we're going to take the total from 8A through 8Z and enter here on line 9. So that now we can total the unemployment and the cancellation of debt to get additional income of $62.50. The instructions tell us to move this amount from line 10, the $62.50, to form 1040, line 8. So we'll go back over to our 1040 and line 8, list the additional income. So we'll enter the $62.50 here. Now that we have most of our income entered, we can calculate the taxpayer's taxable Social Security. And in your assignments, you're provided with a simplified taxable Social Security worksheet. The worksheet wants us to enter the total amount of Social Security. So that was $78.10, and now we're going to put half of that on line 2. So half of $78.10 is $39.05. Now we're asked to enter the total of taxable income items from Form 1040. So we were going to have to go back over to the 1040 for that. And we'll start up here and we'll add the earned income of $25,200. We're going to add the pensions and annuities of $14,100. Okay, not the Social Security. We'll utilize that a little later. We have additional income of $62.50 for a total of $45,550. So we're going to come over to our worksheet and enter the total there on line 3, $45,550. There's no tax-exempt interest, so we're going to add lines 2 through 4 on line 5, and that gives us $49,455. On line 6, we don't have any AGI adjustments. For line 7, it says subtract line 6 from line 5, so we didn't have anything, so we'll just bring the $49,455 down to line 7. Line 8 says enter $25,000 or $32,000 if married filing jointly. So the taxpayer, they are filing jointly, so we'll enter $32,000. And now we're going to subtract line 8 from line 7. So $49,455 less $32,000 is $17,455. Now on line 9 or line 10, it says enter $12,000 if married filing jointly. And then we're going to subtract the $12,000 from line 9, which will give us $5,455. Enter the smaller of 9 or 10. So line 10 is 12,000, it's the lowest. Enter 1/2 of line 12. Now enter the smaller of line 2, which is 3905, or line 13. So the 3905 is smaller. Multiply line 11 by 85%. Okay, so that's 4637. And then add lines 14 and 15. So that will give us 8542. Multiply line 1, that's our Social Security benefits, by 85%. Okay, and that'll give us 6639. So the taxable benefits are the smaller of line 16 or 17. So 6639 is the amount of our taxable Social Security. So we'll go back over to the 1040, and in the taxable amount, we'll enter the 6639. So now we have everything we need to calculate our total income. Down on line 9, it says to add 1Z, 2B, 3B, 4B, 5B, 6B, 7A, and 8. So 1Z was the 25.2. Then 5B is 14.1 plus 66.39 plus the 62.50. And when we add those figures, we get 52.189 as our total income. We don't have any adjustments from Schedule 1, so we will bring the 52.189 on down. Now we'll move on to the tax and credit section, where we're going to have to figure out our standard deduction. Now on line 12D, it asks if you, which would be Carl, or his spouse Mary, was born before January 2nd, 1961, and we know that Carl was. So he's going to get that additional standard deduction. Now we can scroll down to the bottom of this form and find the standard deduction chart. They're married filing jointly, and one of the boxes is checked, so we know that the standard deduction is $33,100. For 2025, seniors are entitled to an even larger standard deduction, so we'll need to go over to Schedule 1A and complete that form to see what the additional deduction is. So on line 1, they're asking for the amount from 1040, line 11B. Okay, so 11B, we didn't bring that down, but that's the 52,189. That's the adjusted gross income from 11A. Okay, and we don't have any of these other income items, so we're going to just bring that figure down to 52,189 on line 3. Okay, no tax on tips doesn't apply to them. No tax on overtime doesn't apply. No tax on car loan interest doesn't apply. The Part 5 enhanced deduction for seniors does apply. So it says enter the amount from line 3, and that was the $52,189. Enter $150,000 if married filing jointly. Okay, there's one more zero. Yep. On 33, subtract line 32 from 31. I see a lot of students make errors in this case. You can't deduct $150,000 from $52,000. Get a big negative number. So I'm going to enter 0. It says if 0 or less, enter 6,000 on line 35. So it is 0. So I'm going to go down to line 35 and enter the 6,000. So make sure that you're careful when you're subtracting. It says subtract 32 from 31. And 31's a smaller number, so you can't subtract it. You'll get something less than 0, so you'll have to enter 0 there. Okay, on 36A, we're just going to bring that figure down. We do have a valid Social Security number. And we don't have to worry about 36B because Mary is not over 65. So their total enhanced deduction is the $6,000 added to their regular standard deduction. Part 6 is where we total all the additional deductions, and the $6,000 was all that they had. And it just says to enter that on 1040 line 13B. So on 13B, we'll enter the $6,000. Now that we've entered our enhanced deduction from Schedule 1A, we can add up lines 12E and 13B and get the total deductions from income of $39,100. We're going to subtract this figure from our taxable income. All taxpayers are entitled to a standard deduction, and in this case, even an additional deduction for the seniors. To get the taxpayer's taxable income, we're going to subtract the $39,100 from the $52,189. So the taxable income is $13,089. Now the most important line is the tax. So we're going to go to our tax tables and look up $13,089. So we'll use the tax table provided in the problem. We'll go down to 13,050 to 13,001, and we need to be on the married filing jointly column, and that is the second column. So their tax is $1,308. So on the 1040, on the tax line, we're going to enter $1,308. We have no additional taxes on Schedule 2, so we'll bring that on down to line 18. We have no credits to add, so we'll bring the $1,308 on down to line 22. So that's going to be our total tax. Next, we need to figure out how much in federal income tax was withheld from the W-2s and the 1099s and the other forms. So let's go back to the problem, and we'll see that on the W-2, 2106 was withheld. So on line A, we'll enter the 2106. On the forms 1099, there were a few of those. So he had the 1099R where $1,200 was withheld. He also had $320 withheld from Social Security. And then there was another form. Let's see. There was nothing withheld on the 1099-C. The 1099-G had $240 withheld. Okay, so if we go back, we're going to enter on Forms 1099 the $1,760. Now we have a total in taxes withheld of lines 25A and 25B, and that's $38.66. So we're going to bring that figure all the way down to 33 because there was no other payments or refundable credits. So now it's time to settle up. Their tax liability was $1,308, and they had $38.66 withheld or prepaid. So if we subtract, we know that the taxpayers have overpaid their taxes by $2,558, and they would like all $2,558 refunded.